Welcome to the deep dive. You've pulled together a really fascinating set of materials for us this time.
Yeah, so look back at investment tools from around 2001.
Right, it's like a time capsule showing how investors back then were trying to, figure out the whole buy low, sell high puzzle at the turn of the millennium.
Exactly. And it's interesting to see what principles were guiding them.
So, our mission today is to unpack these tools, understand their logic, and see what, if anything, still holds water today.
Definitely. We've got a mix of things, market indicators, company analysis, the works.
Okay, let's dive in. How were people getting a read on the market's health back then? We've got some benchmarks here that might sound a bit unfamiliar now. First, the AMX Major Market Index.
Ah, yes. That wasn't really a broad market measure like, say, the S&P 500.
Okay, how'd it work?
It was a price-weighted average. Only 20 big industrial stocks from the NYSE.
Just 20.
Yep. And 19 of them were also in the Dow Jones Industrial Average at the time. Being price-weighted meant the stocks with higher prices had a much bigger impact.
So a $100 stock moved the needle more than a $10 stock, even if the $10 stock company was bigger overall.
Precisely. It's different from market cap weighting, which is more common now. Its baseline was 200 back in '83.
Got it. A very focused snapshot then. What about the AMAX Institutional Index? Sounds like tracking the big money.
That was the idea. It followed 75 companies with significant ownership by institutions, think pension funds, mutual funds.
And there were specific rules for getting in.
Yeah, a company needed at least 7 million shares traded and minimum of 200 institutional investors holding its stock.
So trying to follow the supposedly smarter, bigger players.
Kind of like trying to see where the herd of elephants was heading, yeah.
Okay. Now, shifting to the tech craze era, the NASDAQ Q Internet Index, that definitely takes us back.
Oh, absolutely. Peak.com. This was a market value-weighted index focused purely on internet companies.
Market value weighted, so bigger companies mattered more here.
Correct. Unlike the Amex Major Market Index, if you look at who was in it around December '98,
Yeah.
Amazon, AOL, Cisco, Yahoo, even Netscape. It's a who's who of the early internet giants.
Wow. Dial-up modems ringing in my ears. Okay, last one in this group, Barron's 50 stock average. Different purpose again.
Yeah, this one was an unweighted average of 50 stocks. It wasn't meant as a broad market tracker,
What was it for them?
more of a valuation yardstick. Barron's compared this average to the projected earnings of those 50 companies.
So trying to gauge if the market seemed expensive or cheap based on those specific stocks.
Exactly. But like the Dow, you have to remember it wasn't representing the whole market picture.
Okay, so those are some of the gauges. Now, how about trying to figure out the mood of the market? Sentiment and momentum indicators. First up, the ARMS index. Sounds complex.
It is a bit technical, also called the TRIN. It looks at the relationship between advancing and declining stocks.
Okay, the number going up versus down.
Right, but it adds volume into the mix. It's the ratio of advancing to declining issues divided by the ratio of advancing to declining volume.
Ah, okay. So volume matters.
Yeah, it was calculated for NYSE, Amex, and NASDAQ. The idea was to see if the trading volume was actually confirming the price moves. High volume on an up day is stronger than low volume.
That makes sense. Conviction behind the move.
Yeah.
Then we have the contrary opinion rule. More psychological, this one.
Definitely. The core idea is that the majority, the crowd, is usually wrong at major market turning points.
So do the opposite of whatever everyone else is doing?
That's the contrarian playbook, basically. The theory goes that everyone gets too excited and buys at the top, and too scared and sells at the bottom.
Creating opportunities for those going against the flow.
Exactly. Buy when there's blood in the streets, sell when there's euphoria.
And to try and measure that sentiment, we have the index of bearish sentiment.
Right, this index came from Investors Intelligence. They tracked the percentage of investment advisory newsletters that were bearish on the market.
So looking at what the pros were saying?
Kind of, but applying that contrary rule again. If a high percentage of advisors were bearish, say, over 42% in the example provided.
That was actually a buy signal.
Correct. The thinking was, if almost everyone's pessimistic, the bad news is probably priced in, and it might be time to buy.
And the reverse, if everyone's bullish.
Yeah, a low reading, maybe only 10% bearish, could be a sell signal. Too much optimism might mean the market's getting frothy. They even suggested a jump towards 60% bearish could signal a bottom.
Fascinating stuff, trying to quantify herd mentality. Okay, let's shift gears. How were people thinking about dividing up their money? Asset allocation. We've got some examples from around 2000.
Yes, these show how a major Wall Street firm advised clients back then. They had different models, from capital preservation up to aggressive growth.
Based on risk tolerance, I assume.
Absolutely. Capital preservation was like 55% bonds, 35% cash, only 10% stocks. Very conservative.
Wow. Barely any stocks.
Right. But then aggressive growth was the opposite, 80% stocks, just 10% bonds, 10% cash.
Shows the range. And we also have American Century Investments approach.
Yeah, they also offered model portfolios, conservative, moderate, aggressive mixing stocks, bonds, and money markets.
And they got specific about the types of funds.
They did. For their moderate portfolio, it was 60% stocks, but broken down into specific funds like equity growth, heritage, ultra funds.
Interesting.
And for the 30% bonds, they mentioned GNMA funds. Those are mortgage-backed securities and intermediate-term bond funds, plus 10% in a capital preservation fund.
So really highlighting mutual funds as the way to get that diversification within asset classes.
Exactly. Funds were becoming central to how individuals invested.
Okay, let's zoom in on the bond market itself, a whole different world of indicators there.
It is. The sources list a ton of bond indexes.
Yeah.
You had broad ones like the Lehman Aggregate Bond Index, covering the whole U.S. investment-grade market.
Kind of like the S&P 500, but for bonds.
Sort of, yeah.
Yeah.
Then you had more focused ones. Lehman Long-Term Treasury Index, for example.
Yeah.
Very sensitive to inflation fears because of the long duration.
Right. And indexes for riskier bonds, too.
Definitely. The first Boston High Yield Index, S&P's junk bond indexes, split into BB-rated and B-rated. Higher potential yields, but much higher default risk.
And on the safer side, treasuries and munis.
Exactly. Treasury indexes like Lehman's Intermediate Term Treasury were benchmarks for government-backed debt, and municipal bond indexes like the Bond Buyer 20 tracked tax-exempt bonds from state and local governments.
And you mentioned something about the relationship between bond index prices and yields.
Yeah, usually they move inversely. Index goes up, yields go down because the price of the bonds in the index went up.
Okay.
But mortgage-backed bonds were noted as an exception sometimes because of prepayment risk.
Ah, because people refinance when rates drop.
Precisely. If homeowners pay back their mortgages early, the bondholder gets their principal back sooner, which messes with the expected yield calculation.
Got it. Okay, stepping back from markets for a second, broader economic indicators. How did these fit into the investment picture?
Hugely important. Still are, obviously. Investors watch things like factory orders, the federal deficit, the trade balance.
Interest rates set by the Fed, the dollar strength.
All of it. Because these things shape the environment companies operate in. Rising interest rates, for instance, were often seen as bad for stocks' higher borrowing costs. Bonds look more attractive.
So keeping tabs on the economy was crucial. And the big one is GDP, gross domestic product.
The broadest measure, yeah. Total value of everything produced in the country. Investors watched the real GDP figure, adjusted for inflation, put out quarterly by the Commerce Department.
And the inflation adjustment part itself was important.
Right, the deflator. That was seen as a key inflation gauge within the GDP report itself.
Okay. What about the index of leading indicators? Sounds predictive.
That was its goal. It combined 10 economic stats that historically tended to move before the overall economy shifted.
Trying to get a 6 to 9 month heads up.
Something like that. Designed to signal recessions or recoveries early. But, the sources rightly cautioned it wasn't foolproof, sometimes gave false signals.
No magic crystal balls, noted. How about manufacturing activity? Factory output, how busy they were.
Yeah, industrial production and capacity utilization. They measured output from mining, manufacturing, utilities. High numbers suggested a strong economy. Low numbers were a warning sign.
And inflation, a perennial concern. What were the main trackers back then?
The usual suspects, mostly. CPI Consumer Price Index, tracking consumer costs. PPI Producer Price Index, tracking prices businesses receive.
The GDP deflator we mentioned.
Right, and the ECI Employment Cost Index for measuring labor costs without distortion from job shifts, all trying to get a handle on rising prices, which erodes investment returns.
How did economists define a recession around that time? Any consensus?
Not one single definition, but the sources mention 3 common ones.
Okay.
3 straight monthly drops in the leading indicators index, or 2 consecutive quarters of falling real GDP.
The classic technical definition.
Right. Or just a significant widespread economic decline lasting more than a few months, a bit more subjective.
What about consumer spending, retail sales figures?
Very important. Collected monthly by the Census Bureau. Since consumer spending drives so much of the U.S. economy, strong sales were seen as healthy, weak sales as a potential slowdown.
And finally, in this economic section, the balance of payments, the dollar, and the euro, which was pretty new then.
Right. Balance of payments tracked money flows between the U.S. and the world trade. Finance. The dollar's value mattered a lot.
How so?
Well, a weak dollar helps exporters, but can raise import costs and inflation. A strong dollar does the opposite, cheaper imports, but tougher for exporters.
And the euro.
It had just launched, technically, based on the old ECU, European Currency Unit, but the physical cash wasn't out yet that came in 2002.
So it was kind of a placeholder currency.
In a way, its value was fixed against things like the German mark, but for U.S. investors with European holdings, the dollar-euro exchange rate was already something to watch.
Okay, great overview of the macro picture. Now let's zoom right back in. How were investors analyzing specific companies? We start with beta, but for a mutual fund.
Right. Beta measures a fund's volatility relative to the market, usually the S&P 500.
Like we discussed for stocks, but applied to a whole fund.
Exactly. Beta of 1 means it moves with the market. Over 1, it's more volatile. Bigger swings up and down. Under 1, less volatile.
How is it calculated?
Statistically, looking at past returns of the fund versus the market, it quantifies that non-diversifiable systematic risk. They even mentioned using beta, the risk-free rate, and market return to estimate a fund's expected return.
Interesting. So understanding its sensitivity to the whole market, what about earnings surprises?
Big news for a stock. That's when a company reports earnings profit per share that are way different from what analysts expected.
And the market reacts.
Oh yeah. A positive surprise beating expectations usually boosts the stock price. Sign of strength.
And a negative surprise.
Falling short. That's often bad news, especially for growth stocks, can lead to sell-offs. These surprises, collectively, could also hint at the economy's overall health.
Makes sense. Next, profitability analysis. Pretty fundamental.
Absolutely. Can the company make money? Is it getting a good return on investment? Key metrics here are profit margins.
Gross margin and net margin.
Right. Gross margin looks at profit after the direct cost of producing goods. Net margin is the bottom line profit after all expenses. You look at these as a percentage of revenue.
And compare them over time. And to competitors.
Exactly. Shows operating efficiency, pricing power, competitive strength.
Then there's quality of earnings. Sounds like looking deeper than the headline number.
That's the idea. Reported net income can sometimes be misleading. Are there one-off gains? Unsustainable accounting tricks.
Things that make the profit look better than the core business is actually doing.
Precisely. Quality of earnings analysis tries to adjust for that, to get a more realistic view of sustainable operational profit. Salomon Brothers even had an earnings quality index trying to flag this.
Digging beneath the surface. Okay. Common size and vertical analysis.
These are ways to look at financial statements. You express everything as a percentage of a base figure.
Like on the income statement, everything as percent of total sales.
Exactly. Or on the balance sheet, every asset as a percent of total assets.
Why do that?
It makes it much easier to compare. You can see trends within the company over time, like if costs are rising as a percentage of sales. And you can compare the company to competitors, even if they're different sizes. It shows the structure and efficiency.
Got it. Now, a whole bunch of share price ratios. Let's hit the key ones. Cash flow per share.
That's cash generated from operations divided by the number of shares. It's seen as important because cash flow is, well, cash. Harder to manipulate than accounting earnings sometimes.
And that's what funds the business.
Right, operations growth. But high cash flow per share doesn't automatically mean it's a great investment on its own.
Okay. Next, earnings per share, EPS. Probably the most watched number.
Arguably, yes. It's the company's profit allocated to each share of stock. You should see two versions, basic EPS and diluted EPS, which accounts for things like stock options that could create more shares.
And investors use this to track performance.
Absolutely. Looking at EPS growth over time, often the compound annual growth rate is fundamental for assessing performance and growth potential.
How about price to book value ratio?
This compares the stock's market price to its book value per share. Book value is roughly assets minus liabilities on the balance sheet on a per share basis.
And value investors like this one.
Often, yes. A low price to book ratio might suggest the stock is undervalued relative to its net assets. A high ratio might suggest it's overvalued.
But you need other indicators too.
Definitely. And it works better for some industries than others. Book value isn't always a great measure of a company's true worth, especially for service or tech companies.
Right. Price-earnings ratio, the PE multiple, another classic.
Super common. Market price per share divided by earnings per share. It tells you how much investors are willing to pay for $1 of the company's earnings.
So a high PE means high confidence in future growth.
Generally, yes. Investors expect earnings to rise significantly, justifying the higher price today. A low PE might mean low growth expectations, or maybe the stock is overlooked.
And lastly here, price to sales ratio.
Market cap divided by total sales or revenue. This one's useful when earnings are low or negative, making the PE ratio kind of meaningless.
Like for a fast-growing company reinvesting everything, maybe.
Exactly. Or a company in a temporary slump. A lower price-to-sales ratio might suggest it's undervalued based on its revenue generation.
Okay, that covers a lot on the fundamental side. Let's switch to technical analysis, trying to predict prices based on past patterns. Point and figure charts.
These look pretty different. They don't track time on the horizontal axis, just price movements. X is for rising prices, O's the falling prices.
How do they help?
They focus on trends and reversals. A new column only starts when the price reverses by a set amount. They're used to identify support and resistance levels.
Support being a price floor, resistance a ceiling.
Basically, yeah. Where buying or selling pressure tends to kick in. A breakout above resistance or below support is seen as a significant signal.
Visual price action. Moving averages are more common today, I think.
Very common. You average the price over a set period, 50 days, 200 days, whatever.
To smooth out the noise.
Exactly. It creates a line on the chart showing the underlying trend. Analysts look for price crossing the average, or short-term averages crossing long-term ones, as buy or sell signals. The examples mentioned 4-month and even 3-day averages for shorter-term trends.
Okay. Japanese candlestick charts, those distinctive blocky things with lines?
Right. They pack a lot of info into one symbol for a given period, like a day.
What info?
The open, high, low, and closing price. The main body shows the open to close range, colored differently depending on whether the price went up or down. The wicks, or shadows, show the full high-low range.
And patterns in these candles mean something.
Yes. Technical analysts interpret various candlestick patterns to gauge market sentiment and potential short-term moves. Very popular in futures trading.
Relative strength analysis. Is that comparing a SMAF to the market?
Exactly. It compares stocks' performance, or an industry's, to a benchmark like the S&P 500.
To find outperformers.
Yeah, the idea is to identify stocks that are stronger than the market, hoping that strength continues. Often shown as a ratio line on a chart.
Momentum gauges, or oscillators. Measuring the speed of price changes.
Right. How fast is the price moving? These indicators try to measure that strength. They often fluctuate within a range, helping to spot overbought or oversold conditions.
Meaning a reversal might be coming.
That's the theory. The rate of change, ROC indicator, was mentioned, just the percentage price change over a period. The advanced decline line is another type, tracking market breadth as momentum.
Support and resistance levels. We mentioned these with point and figure. Fundamental concept.
Very fundamental in technical analysis. Price levels where past buying support or selling resistance emerged. Traders watch these levels closely.
Because a break through them is important.
A breakout above resistance is usually bullish. A breakdown below support is bearish. Signals a potential continuation of the move.
The tick indicator sounds very short-term.
Extremely short-term, intraday. It's the net difference between stocks trading on an uptick, higher than the last trade, and a downtick, lower on the NYSE at any given moment.
What's it used for?
High positive ticks suggest intense buying, maybe overbought. Big negative ticks suggest heavy selling, maybe oversold. Hints at potential tiny reversals.
And finally, volume analysis. Looking at how many shares are traded.
Crucial context for price moves. High volume when the price goes up. Bullish sign, strong conviction.
High volume when price goes down.
Bearish, lots of selling pressure. Low volume during a rally can be a warning sign. Maybe the move lacks broad support. Volume helps confirm or question price signals.
Okay, that covers the technical tools. Let's move to analyzing mutual funds specifically. Lipper mutual fund indexes.
Lipper provided benchmarks for different fund categories, growth, value, etc. Their key feature was equal weighting.
Meaning small funds counted just as much as huge funds in the index.
Within the same category, yes. Different from market cap weighting. It gave a different view of how the average fund in the category was doing.
And they also ranked individual funds. Lipper mutual fund rankings.
Yes, they compared funds within categories based purely on past performance total return. Weekly, monthly, quarterly reports, plus long-term track records. Widely used for fund selection.
Morningstar's another big name. They had their star ratings.
Still do. The 1 to 5 star system. Crucially, it was based on risk-adjusted performance.
Not just raw return.
No, it factored in the risk taken to achieve those returns, using metrics like standard deviation. A 5-star fund performed well for the amount of risk it took compared to its peers. Very influential.
Net asset value. NAV, the basic price of a fund share.
Essentially, yes. It's the total market value of everything the fund owns, minus liabilities divided by the number of shares, calculated daily. That's the price you buy or sell at for open-end funds.
We talked about beta for funds. What about alpha?
Alpha measures the manager's contribution, you could say. It's the fund's return above what you'd expect based on its beta market risk.
So positive alpha means the manager added value beyond just tracking the market.
Exactly. Negative alpha means they underperformed on a risk-adjusted basis compared to the benchmark. It's a measure of skill, theoretically.
Beta for a mutual fund, just reinforcing it, measures market sensitivity.
Yep, same concept. How much does the fund swing when the market swings? Key risk measure.
Risk-adjusted return using the Sharpe ratio. How does that work?
The Sharpe ratio looks at the fund's return above the risk-free rate, like T-bills, and divides that by its total volatility, standard deviation.
Higher Sharpe ratio is better.
Yes. Means you got more return for each unit of risk taken. Good way to compare funds with different risk levels.
And standard deviation itself just measures that volatility.
Correct. Measures how much the fund's returns typically bounce around its average return. Higher standard deviation means more volatile, bigger swings. Lower means smoother ride.
Mutual fund sales figures. Tracking flows in and out of funds.
Yeah, monthly reports showing how much money investors put into funds sales versus took out redemptions. Seen as a gauge of small investor sentiment.
Lots of money going in means optimism.
Generally, yes. Net redemptions might signal caution or pessimism among individual investors.
What about the mutual fund cash position? How much cash funds are holding?
The ratio of cash to total assets, sometimes interpreted as a signal of manager's market outlook.
Lower cash means bullish, putting money to work.
That's one interpretation.
Right.
Rising cash might mean managers are cautious, holding back for better opportunities or expecting a downturn, but it's not always clear-cut. Funds need cash for redemptions too.
Total return for a mutual fund, the bottom line.
Pretty much. It captures everything, the change in NAV plus any dividends or capital gains distributed, assuming they're reinvested. It's the overall performance number.
And lastly, for funds, the Morningstar style boxes, those 9-box grids.
Exactly. For stocks, it plots funds based on size, large, mid, small cap, and style, value, blend, growth. For bonds, it uses credit quality and interest rate sensitivity, duration.
Just a quick visual way to see a fund strategy.
Yeah, it helps you understand its focus and build a diversified portfolio across different styles. Very useful tool.
Okay, almost there. Let's quickly cover some other investment tools mentioned. Arbitrage.
Classic strategy. Buying something in one market and instantly selling it in another for a slightly higher price. Exploiting tiny temporary price differences. Helps make markets efficient.
Closed-end mutual fund averages, different from the open-end funds.
Yeah, closed-end funds have a fixed number of shares traded on exchanges, like stocks. Their price can deviate from their NAV, trading at a premium or discount based on supply and demand. Tracking averages gave another sentiment read.
Commodities indexes, like the CRB index.
Tracked baskets of raw materials, energy, metals, agriculture, used as inflation barometers, basically. Rising commodities often signal future inflation.
Credit ratings from Moody's and S&P, still vital today.
Absolutely. Assess the risk of borrowers, companies, governments defaulting on their debt. Higher rating means lower risk. Essential for bond investors, and trends can reflect economic health.
Crude oil spot price, always in the news.
Key indicator. Reflects global tensions, impacts inflation, affects oil company profits, influences stock and bond markets. Huge ripple effects.
The other Dow Jones averages transportation and utility.
The transports, airlines, railroads, often seen as a leading economic indicator because their business reflects economic activity. Utilities are more defensive, watched for their dividend yields, but also subject to regulation.
Real estate metrics, gross income multiplier, GIM, and net income multiplier, NIM.
Quick valuation tools for income properties, price divided by gross income, GIM, or net operating income, NIM. Rules of thumb, really, not deep analysis.
No index numbers, just a basic statistical tool.
Yeah, expressing data relative to a base period set to 100 to easily see percentage changes over time, used everywhere.
Insider trading activity, watching what execs are doing.
Some investors follow it. Theory is, insiders know more. Heavy insider buying seen as bullish. Selling is potentially bearish. But insiders sell for many reasons, and the data isn't always timely.
Key interest rates, Fed funds, discount rate, prime rate.
Reflect Fed policy and banking conditions. Fed funds is bank-to-bank overnight lending. Discount rate is borrowing in from the Fed. Prime is the benchmark for many consumer business loans. Rising rates usually signal tighter money, potentially negative for stocks bonds.
The 30-year Treasury bond yield, a major benchmark.
Hugely watched. Seen as a proxy for long-term economic outlook and inflation expectations. Influences mortgage rates and other long-term borrowing costs.
And the 3-month Treasury bill yield, short-term benchmark.
Key rate for safe, short-term cash. Often used as the risk-free rate. Rising T-bill yields can make cash more attractive than riskier assets, but might also signal a strengthening economy.
Mortgage rates affects housing, consumer finances.
Weekly averages tracked for fixed and adjustable rates. Big impact on housing affordability and the broader economy.
New highs and lows on the exchange, market breadth indicator.
Right. Lots of stocks hitting 52-week highs suggests broad strength. Lots hitting lows suggests weakness. Helps gauge the health of a rally or decline.
NYSE indexes beyond the composite.
Yeah, sector indexes for industrials, transports, utilities, financials listed on the NYSE. Useful for confirming trends seen in broader indexes or analyzing specific sectors.
Odd lot theory, another contrarian play.
Similar idea to the contrary opinion rule. Assumes small investors trading odd lots, less than 100 shares, are usually wrong. So do the opposite.
Put-call options premium ratio, comparing the price of bearish bets versus bullish bets.
Exactly. Puts are bets on falling prices, calls on rising prices. If put premiums get expensive relative to calls, it might suggest growing bearishness or demand for downside protection.
Real estate performance averages, like NCREF, tracking commercial property.
Yeah, tracks returns for different property types, office, retail, and regions. Gives institutional investors data on real estate performance trends.
Russell 2000 Index, the small cap benchmark.
That's the one. Tracks 2,000 smaller U.S. companies. Key gauge for small company stock performance.
Short selling indicators, short interest ratio and specialist public short ratio.
Short interest ratio compares shares sold short to average trading volume. High ratio could mean negative sentiment or fuel for a short squeeze. The S-key ratio compared shorting by NYSE specialists, seen as smart money, to the public.
Stock splits, changes the share count and price.
Right, like a 2-for-1 split doubles your shares, halves the price, doesn't change the company's value or your total stake. Often seen as a sign of confidence, makes the price seem more accessible.
Total return for stocks, the ultimate measure again.
Yep, price change plus dividends received, what you actually made or lost.
Up to down volume ratio, volume behind the winners versus losers.
Compares volume in advancing stocks to volume in declining stocks. High ratio, or volume on the upside, suggests strong buying accumulation. Low ratio suggests distribution selling pressure.
Value averaging, a specific investment strategy.
Different from dollar cost averaging. You aim for your portfolio value to increase by a fixed dollar amount each period. So you invest more when the market is down, less when it's up, to hit that target value increase.
Wilshire 5000 Equity Index, the total market index.
Pretty much. A very broad market cap weighted index aiming to capture the entire U.S. stock market. Thousands of stocks.
Yield curve, bond yields versus maturity.
Crucial bond market indicator. Plots yields for different maturities. Its shape, upward sloping, flat, inverted, offers clues about future rate expectations and economic growth. Inverted curve often precedes recessions.
And finally, just some basic financial math. APR, yield, dividend yield, payout ratio, taxable equivalent yield, warrants, most active stocks.
Yeah, foundational stuff. APR is the true annual cost of borrowing. Yield is your return percentage. Dividend yield is stock income return. Payout ratio is how much profit goes to dividends. Taxable equivalent yield helps compare muni bonds to taxable ones. Warrants are long-term stock options, and watching most active stocks can sometimes hint at where the market's attention is focused.
Wow. Okay, we really did cover a huge amount of ground there. A proper deep dive into those investment tools from the 2001 era.
We certainly did.
You should definitely have a much clearer picture now of the landscape investors were navigating back then, the indicators they watched, the ratios they calculated, the theories they followed to try and, buy low and sell high.
And what strikes me is, while the specific tools might evolve, think about the data and tech we have now compared to 2001. The underlying questions haven't changed that much.
That's a great point. Still trying to gauge sentiment, assess value, manage risk.
Exactly. Understanding market psychology, figuring out if something's cheap or expensive, deciding how much risk to take, those are timeless challenges for investors.
Absolutely. So maybe a final thought for you to chew on. Considering how much has changed since 2001, the sheer volume of data, the speed of information, the algorithms, new metrics, how have these core investment ideas adapted? What new tools or data points might today's investors be leaning on more heavily in that same quest to understand the market and make smart decisions in this constantly shifting landscape? Thinking about these older tools really gives you a baseline to appreciate how things have evolved.
It definitely does. Provides
Yep.
valuable context.
Well, thanks for joining us for this deep dive.